After a fantastic start to the year, the equity markets around the world are stumbling a little bit. What's the way forward and what's the outlook for the Indian equity markets? I have with me Amit Jain, Senior Portfolio Manager with Kotak Mahindra Asset Management Singapore Private Limited. Hi Amit. Let's start off by talking about what we've been witnessing in the equity markets. There have, of course, been a plethora of factors as well, right? From the crisis in the Middle East to developments on the US Fed front. What's your take on the market moving factors?
So basically, in terms of what the market has recently seen, is on the geopolitical side, there has been some tensions in the Middle East, which have seemed to have quietened down, and we hope it stays that way. We've also seen the Fed sort of delay its rate cuts. So earlier at the beginning of the year, it was expected that the Fed would probably cut between 3 to 4 times this year. It is now expected that the number of rate cuts is going to be between 1 and 2. So as a result, what we're also going to see is that the Central Bank of India, which is the RBI, is also sort of going to cut maybe once this year. So this is going to be a shallow rate cut. Despite all this, the markets have sort of rebounded back in the last 1 month, and that's precisely because the earnings itself have been strong. So what we're seeing is, despite all these global events, the Indian market is showing resilience.
Like you mentioned, the Indian equity markets have been relatively stable, but I guess that's what gives the markets those higher valuations. And, that's a key problem really with the markets in India, that the valuations are relatively high. Do you think India deserves or commands those premium valuations, and is that justified?
Nifty, which is a large cap index for India, is now trading at about 20 times 1 year forward earnings. This is about 10 to 15% more expensive than its long term average. But there are some major changes that have happened compared to the past, which sort of make these valuations sustainable. So, some of them to enlist would be that India is now clearly the fastest growing economy in the large size economies of the world. Earlier, we used to see even China sort of grow in line or maybe even faster than India, but that no longer is the case. Secondly, what you're seeing is GDP growth is translating into strong earnings growth for the companies in India. As a result, investors are getting rewarded for owning the country. Third, you're also seeing some of the risks which used to be associated with a developing country dissipate to quite a big extent. If you look at, for example, the current account deficit, India used to be a part of the fragile five not too long ago. India used to have a current account deficit of 5% almost 10 years back. Today, that is almost close to 1%. This has been driven by a lot of initiatives taken by the current government. Secondly, if you look at inflation, inflation earlier used to be very high in India. Currently, the Indian inflation is around 3.3%, which is almost in line with what the US is facing. So if you look at the central bank sort of targeting the inflation to 4% plus minus 2, it's in a big way helping inflation be very range bound. Thirdly, if you look at the reserves that India currently has $643 billion in its forex reserves, which is a big strength for its currency. What you've also seen is that the fiscal deficit, which used to be 9.2% at the peak of COVID, is now down to 5.8% and is being targeted to be taken to 4.5% by the end of fiscal year 26. Now, this together with what we've seen with the banking system, which is a reflection of the state of affairs of the economy, is that the banking system today has the lowest NPL levels and the highest tier 1 ratios. What this does is that the banking system is today ready to help India's companies grow at a very fast pace. Lastly, in terms of flows, is also what is driving India's market multiples. We have seen a very strong domestic flows in the country over the last few years. We might call this the 401k moment of India, but the strong SIP flows, which are sticky in nature and close to $2 billion a month coming from domestic retail investors, are clearly going to keep the market multiples elevated.
We have elections in India. Do you expect heightened volatility amidst that?
So if you look in India, elections is held over a very long period of time. It is almost held over a period of 2 months. So basically some excitement around elections is bound to happen. But unlike most other times, if you look at the opinion polls across different organizations that have done it, basically it's expected that the current incumbent government, which is BJP, is going to probably come in with a thumping majority. And so it's very unlikely that we are going to see heightened volatility around this. There might be some volatility, but I wouldn't say it's going to be very heightened.
All right. And finally, just to summarize our conversation, how do you recommend rather foreign investors invest in India?
So my advice to foreign investors would be: look, India is a growth economy, where the economic growth in the country translates into earnings growth. So my advice to investors would be to remain growth biased. At this point in time, we like financial services, we like healthcare, and we like consumer discretionary. And this is all to play the growing Indian middle class. Cyclically, we also like real estate and industrials to basically play on the make in India and the PLI story in India. So my advice to investors would be: India is a buy on dips market. It's a structural market. So use every opportunity you get to buy into India.
Thank you, Amit, for that insightful advice.